Hello, everyone, and welcome to this week's edition of the Stock Market After Hours. My name is Mark Rusin. I'm a CPA here in the state of California, and it is great to be with you guys this week. I hope you're doing well. Hope you had a good, long Memorial weekend. I know this is kind of a short week, so we don't have a ton of news to go over, but there's plenty still to talk about in the stock market right now. So let's start off the same way we always do. Let me know where you're tuning in from and what have you been buying. I know it's only been 2 days this week in particular. I guess we had a few days last week after our after hours. So let me know, since the last time we met, what are some stocks that you've been buying? CG Tan, I see you out there. Drew, checking in from Minneapolis, Minnesota. Blue, good to see you, my friend. Good afternoon. Hoagie, hey y'all. Dan Brown, how we doing? Good to see you. Juan Carlos, thanks for tuning in. Tom, hey, Mark, normally from New Jersey, but St. Thomas on vacation. Very nice. Brazil is in the house. A little more SCHD. Matthew, good to see you. SCHD all the way. Hey, Mark, watching from Chicago suburbs. UT. Another Mark in the house. Like the name there. Cindy, good to see you. John from Tulsa, Oklahoma. Good to see you, my friend. Zadelli, MTPLF. Matt Simmons from Maryland, Lisbon. What are we touring, Blue? Tuning in. Sorry, not turning. Tuning in from Florida. No recent buys. Waiting for some NEE to drop. Nice. NEE, as you know, Blue, because you are a subscriber to the Stock Investor's Edge. You know that has been a stock that I recently added to my share count. Central Florida for Deborah. Jacil, how we doing? Marzia from Italy, one of my favorite countries to visit. Grew up with an Italian family. Tampa, Philly. Cindy's working on her homework. Good. Cindy's part of our 6-week investing accelerator group program right now. So working on her homework. We're going through the midst of analyzing stocks, valuing stocks. So we're in depth right now. So plenty to go through. Watching your videos as always. I appreciate that. Vacaville, I know where that's at here in California. Maine, ARCC, JEPQ, SCHG has been on the buy list for Drew. Eric bought some Hood recently and more SCHD. I like that. Balancing off a little bit of growth, a little bit of dividends there. All about balance. Tyler, good to see you. Tyler Smith, that's a offensive lineman for the Dallas Cowboys. H-Town, Texas is in the house. Speaking of Texas right there. Accumulating HDFC, Indian Bank, which has a wide moat, 2.76 dividend. Rockford, Illinois, selling puts on a lot of stocks. Nice. All right. What else we got? Hood for the win. Hood has been on a tear. Ohio is in the house. Chicago, India. Love it. My own channel. There you go. King David's back. We'll buy some SCHD and a little JEPI SCHG and for D Daily, Maine and SCHD. Little Schwab. We are Buffalo Bills fans around here. They're gonna be a tough out in the AFC this year. Appreciate if you could advise supports and resistance for Tesla and Nvidia. Okay, we'll bring up the charts for those guys in a little bit here. Mama Bear tuning in from Canada. We got Massachusetts. Awesome. We got a good group here today. So let's dive right in, check on stocks, see how things are going. Overall, Tyler said one more, Timberwolves or Thunder. You know, I guess you could say both of them to a degree are a little bit small market overall. But, I think the Thunder have had so many good players go through their doors to not have something to show for it. I'm kind of rooting for the Thunder, but as you know, Southern California, I'm sure you could guess which team I like. I was more of a Kobe guy though. So, all right, so let's jump back into the markets. Today's going to be an iPad day. I know you guys like me to kind of shuffle it back and forth. So some days we have the slides up. Some days we just kind of go off of our iPad here. So let's take a look first at how the Dow Jones is doing. So the Dow Jones today dropped more than 200 points. As you can see there on your screen, taking a look down below at the breadth, we could see that we had 2,000 declining in the New York Stock Exchange to 700 advancing, 3,000 on the NASDAQ declining to 1,400 advancing there in the NASDAQ. So you see the Dow Jones was down over 200 points. We could see on a year-to-date basis, it's crept back into negative territory. So down 1% over the past 3 months, though, down 3% the past month, though. We've had a little bit of momentum, has stalled a bit, though, up 3.5% there. If we go back to the homepage, let's take a peek at our S&P 500, which is what I'm more focused on, not the Dow Jones. I could care less most of the time when it comes to the Dow Jones. So looking at performance here, we could see that over the past 3 months, we are negative, down 1.1% there. Year to date, small little gain there. We'll call it even. Over the past 5 days, up less than 1%. Again, things have really stalled here of late, but late April is when we started to see our momentum. Early to mid-May is when we saw the continuation, but really since then, it's been a bit of a sideways kind of drudging through the mud type of, I should say, market overall. So let's take a peek at our fear and greed index. And again, right now we're still sitting at greed with a full 65. It's quite interesting that we see here, because just a month ago we were sitting at 36. If you go back a month and a half ago, we were sitting close to zero with we were in the low teens. It was one of the lowest that I've ever seen on the fear and greed index. But those are the times that Buffett often talks about. We want to be what? Greedy when others are fearful, and fearful when others are greedy. Right now, the market, according to the index, is taking an approach of there's a lot more greed in the market. So we want to be mindful of that. Are we rushing out to buy things? Probably shouldn't be. Does that mean we don't buy anything? No, because I again, you've heard me say it often. I much prefer time in the market over trying to time the market. So again, we never just completely cut things off, but there is a lot to be kind of concerned about as investors right now. If you think about it, we have earnings, and the earnings season that we just went through, which Nvidia kind of just put a cap on it at the very end there. There's still a few earnings, sizable companies that are going to come through. So it's not completely done, but of all of the large companies in terms of, 90+% of the S&P 500 has already reported their latest earnings report. So Nvidia being one of the last here, earnings were better than expected. I think we can all agree on that. But if you've been watching my channel for any amount of time, you've heard me say that I hate that phrase, better than expected. There was so much drawdown after Q1, which was going through the Q4 earnings report, on earnings guidance and the lack of clarity, the uncertainty with tariffs and global tensions. Well, those are still here, guys. A lot of that hasn't changed, and there's still reason to kind of have your guard up to a degree. I know the markets have moved, and we have recovered in what has been the fastest recovery from a 15% drawdown that we have seen. I want to say that when looking at the stats, there was only one other time that we have recovered from a 15% drawdown in less than 100 days. And I want to say that was back in the late 1990s. So don't quote me on that, but I want to say it was in the 98 period or whatever it may be there. So there's still a lot that's uncertain out there. There's still global tensions. When we're talking about a trade deal with China, and then again today we hear about halt all sales to China in terms of chips. That doesn't tell me that, hey, we're still, we're getting on friendlier terms with the other major power in the economic order here, in the pecking order. So there's still those concerns there. There's still tariffs out there. We've kind of kicked the can down the road. So whether you want to say they are going to have an impact, a one-time impact or not, they're going to have an impact. And what are they going to impact? Their attacks here on the American people, on the businesses here, because businesses have to choose. Do I pass this tax on to consumers, lift prices, which increases and puts more pressure on inflation, or do we have to eat them? That's what a business has to ask. Do we eat them, which puts pressure on what? Gross margins. If we're not making as much, for every dollar that we sell, we don't have as much left at the end of the day, earnings comes down, okay? And I know there's plenty of people out there that say, well, these companies are making billions, but we invest on wanting companies to make more. Okay, that's the fact of the matter right now, is we want companies to make more. That's how companies become more valuable. It's not just by getting by. That sounds great and everything. It'll put, make some folks happy, but we invest for companies to make more money, to become more valuable. So when gross margins, operating margins, EBITDA margins are under pressure, there's less money left at the end of the day. So valuations are based on earnings, different types of earnings, based on net income, based on EBITDA, based on sales, things like that. There's a number of different ways. That's what I talk about in my 6-week investing accelerator course, which right now we have full open enrollment going on. So if you're interested, you can check out, book a free 15-minute call, and we'll go through all of the details from price to the customized strategy, the scheduling, and everything like that, the topics we touch. So be mindful of that if you are managing your own portfolio, you do want to know how to do it the right way, because you could lose a ton of money with just a few errors there. So a lot of this is still in front of us. A lot of this is still headwinds. The headwinds far outweigh the tailwinds right now for the US economy. So we still have tariffs. We still have global tensions that are going on between large economic powers, whether it's the EU, whether it's China, and things like that. All of these lead toward headwinds for earnings. So there's a lot of analysts out there right now that are still believing, no, I don't think anything's going to change. The S&P is going to generate $270 per share in earnings. That's some high hopes. Not saying that we can't, but those are some high hopes. Okay, there's a lot of uncertainty around the U.S. fiscal stability, or I should say instability there. Hence why Treasury yields continue to climb higher. That's just showing you that they need, for those of you that are unaware, there's an inverse relationship with bond prices and yields. Bond prices go down, yields go higher. So when the government issues a new set of debt in order to pay off debt that's coming due, they're starting to find that they need to raise yields in order to drum up some demand. That's going to start to weigh on valuations, folks. And if you haven't been around investing for very long, do yourself a favor. Do some due diligence on how treasuries and interest rates can impact earnings for businesses. You could find a ton of videos on YouTube to find some of this on how the impact of high rates impact valuations for public stocks. That is going to be a headwind. All of the tariff stuff that we've been talking about has been a lot of bark. It's been all bark right now because it isn't involved in any of the earnings all that much. A lot of that's been sold in Q1, which is the earnings period that we just went through, things that ended back all the way in March, January through March. Those didn't include the sales of anything that has been impacted by tariffs. If someone bought a widget for $10, that is what was sold in January, February, March, and even April. But now in May and especially June and July, a lot of those products are going to have tariffs attached to them because a lot of those tariffs came into account. Maybe not the super high ones, but there still is the baseline tariffs that are in there. That's going to weigh on margins. That's going to have an impact on inflation. That's going to bring earnings down. So be mindful of that. I'm not going to sit up here and tell you everything's great. Let's just go buy with our eyes closed, because my job, the only reason that I have this YouTube channel, the only reason that I run a 6-week investing accelerator course is to help bring knowledge to the retail investor. My goal is to have no retail investor left behind so that they're knowledgeable about investments, that no longer are they just following people because they say a stock is a buy. They know what to look at to find out for themselves. Number one, does it fit my strategy? Number two, is it a safe, reliable company? And number three, does the valuation make sense? That's my investing process that you learn about in my 6-week investing accelerator program. That's the whole goal of what I do and why I do it here. So that's kind of my take overall on the economy right now. And let's go take a look back at the iPad here to see what's the Fed thing. So we got a June meeting coming up here, and it's really going to be the last kind of in-person meeting that we're going to have for quite some time. And as you can see right now, based on everything that we've heard from the Fed, we got some new meeting minutes that came out today. But based on all of the talking that they've said, there's no reason to decrease. It doesn't sound like there's any reason for them to cut interest rates right now, because we're still, again, we don't know the impact that these tariff goods are going to have until we find some data here over the course of the next 2 months. Okay, and that will show more data. And what has this Fed been very clear with? They're going to be data driven. They're not going to look forward and try and bend the curve here and look ahead. Whether we agree with that or not is a different story. But they are going to let the data, and again, a lot of the data is look back data. Almost all of it is look back data for the most part. So right now we're sitting at 98% looking at the Fed futures that there's going to be no rate cut here for the June meeting. Then we'll go off into Jackson Hole and we have a July meeting. 77% still believe that we will have no change in the Fed funds rate. Not until we get to September do the odds increase. And we can go over here to the probabilities real quick just to see where do we think we will be at the end of the year. So let me zoom in for this for you. So again, right now we are sitting in this range right here, that 425. 97% will stay there in June. 77% believe we will stay there also in July. September, we're still not 50-50, but I guess if you bring all of this in, we're sitting at 58% believes that we will get a 25 basis point cut or potentially even a 50 basis point cut right there. Same boat for October, and then potentially another cut in December there. So right now we are still pricing in 2 cuts as of the end of 2025, which is where we're at right now. So that's what the market is pricing in based on what we have, based on the data that we see right now, based on the Fed funds rate. I'm kind of in the camp of thinking that we'll probably have 1. I'm not quite over into the 2, but that's been something that I've consistently been saying here since we've been looking at based on the data. But again, I'm going to, if something changes, I will be sure to let you guys know on one of these live shows that we have here. So what else? What are some other reasons? Again, this show isn't meant to be a just completely pessimistic type. But again, I want to give you guys the data because everyone's optimistic out there. Everyone was optimistic going into 2025. How did that start off? You need to see both sides of the aisles. There's reasons to be optimistic. Tax cuts could provide an opportunity. The tariffs could provide more activity for US-based companies and things like that. If you get a tariff sell-off and there's certain companies out there that have no impact from tariffs, that could be a great opportunity to buy those stocks. So don't get me wrong. Don't get it twisted in the fact that should all be bearish right now. But we want to be mindful of the headwinds and the tailwinds, which is what we're trying to go through here today. So looking at this chart that I found here, this is the median S&P 500 stock short. So this is the percentage of shorts on S&P 500 companies. And as you can see here, that has exploded in 2025. We are back at the level that we saw in 2020. And what did the markets do from there? We saw a big drop and then a V-shaped recovery right there. So do I believe we will see something of the magnitude of the same? No. Do I believe there's a pullback in order in the near term? Absolutely. That is what I'm saying right here. So right now we're sitting at 2.3% of the market cap of the S&P 500 is short. I'm not someone that ever shorts stocks, so let me tell you right there, I don't have any short positions by any means, but I just thought that was an interesting data point on that right now. Okay, so that is another data point that we want to look at. Here is something focused on the 5th District Survey. So this is focused on manufacturing activity, and if we zoom in on that one here on the iPad, take a closer look, you could see that this period in time right here was right before the election. Once the election happened, we got this big Trump bump here saying, hey, growth's going to be back, so on and so forth. But then this peak that we saw is in March. What happened in March was a lot of the talk of bringing on all of this tariff stuff that's been going on. And that has ramped up more and more. And what have we seen? A decline in activity. We have seen kind of the peak in the near term and 2 consecutive, April, May, 2 consecutive periods in which we've got reports for this survey saying declining manufacturing activity here. So another, not a huge data point that I look at, but something that I like to pay attention to in terms of where are things headed, at least in the near term. And when I talk about near term, I'm talking about over the course of the next 6 weeks there. So in terms of earnings insight, so this is the latest FactSet report that has come out. We could see that, let me zoom in on this for you guys real quick. Right now, the S&P 500 is trading at a PE of 21.1, well above the 5-year average of 19.9, well above the 10-year average of 18.4 as well. So again, valuations are high. Headwinds are evident right there. For a valuation to be high, and I'm willing to pay a higher price, there better be a clear-cut catalyst for something to go higher if I'm pouring tons of money in. So again, as I told you guys at the start, I want to be mindful that I'm not completely not buying anything, because there's still things going on. And if you're an Edge Plus subscriber to my newsletter, you know exactly what I am buying. I'm buying things like NEE, which I think was overblown on the sell-off from that perspective right there. I continue to look for areas of ETFs, whether it's SCHG, whether it's SCHD. I'm looking at valuations for certain healthcare companies, which has been laggards. I'm not always looking for the leading sectors. I'm trying to find some of the high quality companies that are in those dog sectors, the ones that have kind of been left behind in the near term over the past 6 months. Healthcare has been one of the worst performing sectors to look at from that perspective there. So again, valuations are rich at current price points right now, and that's even utilizing a EPS estimate for S&P 500 of around 270. If you heard Jamie Dimon, the CEO of JP Morgan, which takes some of his commentary with a grain of salt, his kind of base case is sitting at maybe we get EPS growth that's zero. No growth here in this particular year for the back half of what we saw. Sure, things were better than expected to start, but now we're going to see the impacts of tariffs. Now we're going to see the impact of higher interest rates. For a lot of companies that have variable rate debt, interest expense just went a lot higher. If they have to pay more money for interest expense, that means less income for the company. That means lower margins for the company overall. These are all things that you have to be mindful of on how all of this kind of plays a role. Higher input costs. We're seeing higher expenses for things like interest. Okay. Lower activity, which could bring revenues down. There's a lot of headwinds to be mindful of in the current market environment right now. There are some folks out there, firms that believe that we could, in fact, even have negative EPS growth as compared to 2024, which that's not really priced in to the markets right now. So paying a rich valuation where growth isn't all that fast doesn't quite line up, but doesn't mean there's not deals to be had out there. So don't let me get that. Let me make sure I'm clear about that. So let me jump back to the comment section, make sure I'm not missing anything right now. CRM, good buying opportunity. So Salesforce, obviously they reported today, so we could take a look at those here in a second. But in terms of Salesforce, this is one that's been high on my watch list. I was kind of hoping for a bit of a drawdown. We'll take a peek to see where shares are at after the conference call to see if they did drop. They did jump up about 5% after reporting. And then right before jumping on this call, they were only up by about 1%. So we'll see where the updated numbers are right now. MVP said, Marco from Marco Island. It's a lot of marks going on here. Florida buying Corteva, the TGX companies. Yeah, I think they got hit a little bit harder than I expected, at least right there. John says Warren Buffett's Berkshire at 503, looking very tempting right there. A lot of cash that they're sitting on right there. All right, what do we got? Only a few equity stocks, not BDCs, available, and most have far outperformed the likes of SCHG, QQQ, and SOX over the past 15 years. While providing higher dividends, APO looks interesting with plenty of dry powder. Hoagie said, Mark, do you have any thoughts on the big, beautiful bill? So I do have thoughts without getting political. So as you guys know, I'm from California. So regardless of which side of the aisle you are on, if you are in California or you are in New York, you're probably happy, rejoicing to hear that the SALT number is getting increased there. So right now, the state and local tax only allows for about $10,000, not only about, but only $10,000, which real estate is quite expensive out here in the state of California. And we're not talking, you don't need a, multi-million dollar, 18-bedroom house to have a high-priced stock out or a high-priced home out here in California. So property taxes can get to 10 grand very quickly in a matter of months that we're talking about. And you're capped out. Everything that you pay in the past used to be a tax credit to yourself or, to lower your taxable income in the past, what has it been, 5 years or so, it has been capped at 10 grand. So right now that cap is proposed to raise to, I believe it's $40,000. Someone else can adjust that if I'm incorrect and not talking facts here. But I believe the last I heard was $40,000. Right now, it's stalled up um, in the Senate. So again, this is one reason that I went out and bought NEE, because the repeal of the clean energy tax hit that particular stock massively. Now, Sunrun was down something like 40%. That's kind of a pure play energy. So there's good reason for that stock to be down. But to see the likes of a Next Era Energy, which is first a utility company and then trying to provide more energy through clean energy, things like solar primarily, and then some wind type stuff. Their business as a utility company can provide for the earnings support, regardless of what's going on with that particular House bill. So the 10% drawdown was as if the company is first and foremost clean energy with solar and everything, where these tax credits played a massive role in the company's existence, and that's just seemingly not the case. Doesn't mean the stock can't continue to go down from here, but a 10% drawdown, I believe, was just everyone hitting sell on any company that had clean energy relationships. Sure, it's going to have a negative impact on Next Era, but not as much as I think some people are anticipating. Now we have the bill that's kind of stalled in the Senate and is expected to be stalled with some adjustments being made, if there is in fact any adjustments to be made. And I just put a video out on YouTube this past week, yesterday actually, in fact, talking about Next Era from that standpoint there. So if we do get any good news to where, hey, it's not a repeal of all of them, or maybe it's just half, you're going to see some of those stocks pop. So could be a high risk play if you're looking for some of those or wanting to do it from an options standpoint. Could be an area to look overall. But from a fiscal standpoint, though, it continues to add to the problem that we already have here. So I understand from one end is the tax cuts could produce growth further, which could eventually bring in more money. But that's kind of that can that we've tried to kick down the road for the past 100+ years from both sides of the aisle there. Hey, Rob's optimistic moving forward, though. So that's what makes a market, though. ALLR looks to be at major support right now. What else we got? Make sure I'm not missing anything. New tax bill is going to increase the withholding tax on foreign investors, something that will hurt stocks. Investing with Rod. How are we doing, Rod? Purchase some SCHB thanks to one of your videos. Awesome. Is Amazon a good buy at the current market price? I'm going to assume that's what CMP stands for there. So Amazon is one of those positions I continuously love. So once it was down to 170, I was pounding the table. And I talk about in for those that go through the Investing Accelerator program, what is the key metrics on how I figured that one out right there. And there was one particular that I talk about right there. 200, I think it's still an okay buy when it's muddling around 200. But if it got back down in the below 180s or in the 180s, I should say mid 180s, I could see myself nibbling again. If it gets in the 170s, though, it's going to be more of an aggressive buy there. But I have nothing but great things. I think the outlook's fantastic. It's a company that has a number of different revenue streams, and that's what I look at. That's what I look for companies that are going to be foundational in my position, meaning in the top 50% overall in terms of weighting. Companies like an Alphabet, companies like an Amazon that aren't reliant on just one or two particular products to kind of bring that whole company with them. No, they have cloud. They obviously have e-commerce. They have their AI investments that they're starting to make as well. They have a number of different things that they're involved with that if one segment is slow, others can pick it up. The same thing with the likes of an Alphabet as well. So be mindful of all of that, especially if you're looking at stocks that are going to have very large weightings within your portfolio as a whole there. So that is some commentary on that one there. Isn't Nvidia still overvalued compared to others? And when you speak of others, Michael, who are you speaking about? Other chip companies are we talking about, or what do we? Mag 7 stocks, which is it there? Howdy, Mark. Thanks for all your videos. Thank you. Awesome. So let's see if I can pop this one open really quick and see if we can show you guys some things that have been going on here. Boom, boom. Let's get that down. All right, so I'm going to kind of give you guys a sneak peek real fast. Let me respond to this really quick. And I will put this in the chat for those of you that are watching live right now. You can check out this link right here. We'll go to subscribe. There we go. So that is a link to the Investing Accelerator. That's my weekly newsletter. That's where we publish all of our content. If you want to get access to my entire portfolio, if you want to see options plays, but we have an entire Discord that you could be a part of as well. So here's a look at the Discord. If some of you guys haven't had the chance to jump in here, we have a free version of this as well. So you can see everything that we have in the server area. So we have, market news. So you'll get a, every single morning when the market's opening right there, you're going to get some information on a morning preview and midday type of content as well. We have our stock chat room where everyone can just talk about what's going on inside the market. But if you do decide to become, we have two main primary subscriptions. We have our Edge Plus, which is where you can get access to my entire portfolio, actually multiple portfolios. You're going to get stock deep dives that we do as well on a number of different companies, in-depth earnings reports. So you could see that last week we published our deep dive on Salesforce there. We also have a scoring system model that we have built. So someone just recently asked on DraftKings, so you can kind of pay attention and see what that looks like. So you can request this if you are a paying subscriber as well, and get a look at that and a number of different scoring models and financial data points and things like that. However, one of our most popular is going to be the Options Edge Plus. So if you're someone that's been looking to make money in options, you're going to see Options Edge Plus, which is where I post my option trades right here. So you can see as of today, some of the option trades that we do, and we do everything on a per contract basis. And the reason I show everything on a per contract is because we have folks that join the program that have small accounts. We have folks that join the program that have multi-million-dollar accounts. So I let you choose. I'm going to show you what the potential gain is, the potential loss is before going into a particular trade, but you get to decide how much risk that you want to take on here. So I show, again, everything on a per contract basis. So today you could see that we closed out of this Google trade right here. That was for a profit, a 70% profit margin right there at $81 per contract. We were in that one for about a week there. We opened a new trade. This was a play on earnings. This was a debit call spread here, looking for a little bit of a pop here in Nvidia, which has seemingly been the case thus far. We'll see if it holds up tomorrow. Again, never trust after hours. We'll see what happens. But this is essentially a look for a bounce there. But we have a number of different trades that we get into. We do an options edge report each week, detailing and covering one specific trade in detail to help you from an education perspective. So if that's ever something that you are interested in, definitely check out that link that I dropped in the comment section. I'll also put it in the description as well. We would love to have you as part of our community there. All right, so now let's jump over to Nvidia, which has been all the buzz. Everyone's been kind of focused on Nvidia, and Nvidia, the earnings were actually pretty decent there. We talked a lot in the past month or so about the markdowns of the H1, what is the H1B or whatever it is, chip that they had a big write down on. Well, that didn't come to fruition. It wasn't as much, I should say, as intended. The write-off was expected to be 5.5 billion. It only came to be 4.5. Why is that? They found about $1 billion to where they can reuse some of the materials for other related things there. So earnings per share came in at 96 cents adjusted compared to 93, what analysts were looking for. Revenue, 44.06 billion. Analysts were looking for 43. I want to say that's the 8th straight quarter in which Nvidia has had a double beat. So that's been fantastic from that standpoint there. But the thing that I want to note right here is my focal point heading into this was margins. So gross margins came in at 61%. Very low from that perspective right there. However, that included that $4.5 billion write-off that we had. If you take that out, margins were 71.3, still above that 70% threshold, which is what I was hoping would hold from right there, which was definitely a big positive overall for the company there. NVIDIA said it expects about $45 billion in sales in the current quarter that they're going through right now. That was slightly below analyst expectations of 45.9, as you can see right there. Company also said its guidance would have been higher by about 8 billion, except for those lost sales from the recent export restriction on China for those H20. That's what it was, the H20 chips there overall. So definitely some interesting things going on with Nvidia. I thought it was a solid quarter there. As we could see from the charts here, we could take a peek at gaming, which we could see quarter over quarter up nearly 50%, year over year. That was up 42%. And we saw gaming actually decrease in the last quarter right there. If we go to over the data centers, that's going to be the green box overall. Here, let me screenshot this for you guys so I can show you guys what we're even talking about. So here's that 40% that we were talking about. And in terms of data centers, 73%. So that's actually the lowest that we have seen since Q1 of 2024 there. So not a great sign overall, but also we can't say we're all that surprised, because when we heard from a lot of the mega cap type companies that purchase from the likes of Nvidia, a lot of them talked about, hey, we're still purchasing a great deal, but we are pulling back to a degree. Microsoft, namely, being one of the largest there. Data center revenue, though, continues to be a stair step higher and higher, reaching $39.1 billion. That's fantastic. Revenue saw a record as well, up to $3.76 billion. And looking at a few different other segments, obviously much smaller here. Automation, automotive, I should say, had 72%. That was the second best there on record in the past couple of years there for Nvidia. But again, not a major segment that we need to pay all that much attention to overall. So I definitely like the margin call, or the margin data, I should say, for Nvidia. Let's get a check to see how Nvidia is doing after hours right now. So as we could see, up 4.35% after hours, sitting at almost $141. So in order for that options trade to be beneficial, we do need to have that, or at least need to close it above 140 to be profitable there overall. So that's where we're at on Nvidia. Let's take a look at Salesforce. So we'll have a peek here at Salesforce. So show my keyboard here, CRM. And let's see how they're doing after hours. So after hours, still, slightly up. Again, that was upwards as high as 5% at one point there. So we can take a look at their charts. Subscription, that reoccurring revenue, is something that I was kind of focused on for the likes of a Salesforce. So we'll take a peek here at their results. So when we see the subscription, that was up 8.3%. So it bounced back to a degree. This was kind of the concern in the latest quarter, which was the slowest growth we have seen. So again, we didn't pop back up to double digits or anything like that, but we did see a bounce back overall, which was definitely good to see overall. But still, they brought, it was less than the prior quarter, so 9.3 compared to 9.45 in Q4 from that standpoint. As we could see over here, service, it was up 7%. That one continued to slow. Not sure what they meant here for what type of sales overall, but CRM sales and service revenues, you could see the difference between the two, continuing that upward, not quite a hockey stick like we saw with Nvidia, but slowly growing. Much more of a mature company there. So, margins is going to continue to be a bit of a focal point for Salesforce. But they were a stock that was, okay in terms of valuation. It was not one that I thought was crazy overvalued, but I was looking for a pullback. And if we did see a 5+% pullback in shares of Salesforce, we still could tomorrow. Anything could happen. That was a stock that that was high on my watch list overall. So Salesforce, Nvidia, two of the larger ones that are reporting right now. Plenty of headwinds to be mindful of in the markets overall. But before we go, let's take one quick look at where we're at from a sector perspective. So we have a peek here. Let's start with the 1 year. So right now, from a year perspective, we can see the three segments that are in the red are going to be materials, healthcare, and energy. On a year-to-date basis, we have a little bit more in terms of red. So we have four sectors: technology, energy, healthcare, consumer discretionary. Over the past 3 months, healthcare, that's what I was talking about earlier, the major laggard that we've had there. Again, there's been kind of that bipartisan, not something you hear all that often here in the States, but we have a bipartisan agreement to try and bring down drug prices overall. That weighed on, if you were part of the healthcare sector, your stock went down. So that's where you can find some good deals right now. When it comes to some valuations over the past month, we have, again, healthcare, energy are the two in the red. The biggest outperformer has been infotech, industrials, consumer discretionary, and communication services. So every sector was finished the day red here today, but hopefully I gave you guys a better outlook on some of the things that maybe you are already thinking about, or some that maybe you aren't thinking about that you need to be mindful of, whether it's higher interest rates, whether it's the tariffs or global tensions or valuation and earnings concerns and things like that. Overall, don't just take everything word for word. As I mentioned, Jamie Dimon looking for 0% growth, but at the same time, 12 months, what was it, 16, 18 months ago, he talked about a hurricane coming in the markets. Stock market was up over 20%. So there's a lot of these folks that come out and talk very bearish, but sometimes I always ask myself, are these guys just trying to get a dip so that they can buy more? Because it seemingly goes, against what they're saying sometimes, because all of a sudden you'll see their 13F filings come out. And it's like, oh, they bought. They bought more than they sold overall. Well, weren't you just talking about a big hurricane coming, a 20-30% drawdown coming, and you were going to buy heading into that? So it doesn't always, go for what they're talking about. But that's all I got for you guys today. Hopefully you enjoyed this session. I know we went a little over our 30 minutes that we normally do here, but just wanted to make sure I touched on everything from an economic perspective, taking a look at Nvidia, taking a look at some of these other data points and things like that to kind of keep you guys in the know. If you're not yet part of our community, the Stock Investors Edge, definitely check out that link in the description there, or in the chat that I put in there. I'll also put it in the description if it's not there yet, so that you can become part of our community. We have the free area, but if you really want access to both myself and my team, subscribe to either Edge Plus or Options Edge Plus, determining on whether you want more stocks related data or more options related data. We would love to have you as part of our growing community there. So thank you guys so much for tuning in to today's live show. It's been a joy speaking with you guys. Hopefully we'll see you next week so we can talk more about a stock market that's climbing. We all want to make money, but be mindful of some of the headwinds heading into to the month of June here. So thank you guys all for tuning in, and we'll see you next week. Take care.